This show is a Phonic Media production.
In this episode,
I'm not.
check your encoder settings, keyframe rate. Ah, that's why.
This show is a Phonic Media production.
In this episode, we're going to talk about what's going on in the world of crypto mining.
It's a fast-moving world, this Web3 stuff. Blink, and you might have missed it. Hello and welcome to this episode of Understanding Crypto, the podcast that helps you to demystify the weird and wonderful world of Web3. As always, I'm going to start by saying hello, I'm James Burt and he is Captain Crypto. The other thing I'm going to say is a massive thank you. We have had two brilliant reviews in the last week, one of which was... I don't know. It was
quite worrying.
Frightening and elating in equal measure. I'll read it out. It's from Odders. So shout out to Odders. Thank you very much. I know that you could be listening because you're a fan of the show and we appreciate you, Odders. The title of it was Awesome. Keep it up. And he says, Odders says, he or she says, I work in financial services compliance. Bear that in mind. Just let me read that again. I work in financial services compliance, and these podcasts are so useful, relevant, and they're often my go-to for up-and-coming world of crypto asset regulation.
I don't know if we should be chuffed or concerned.
I think in equal measure of both. So let's just say for Odders and everybody else that nothing we say here should be considered financial advice or financial services compliance-based advice. But thanks, Odders. We appreciate the feedback. We are very grateful. Yeah, thank you very much. Awesome stuff. Right, yeah, so we're going to get into crypto mining today and some of the latest stuff that's happening in the world of crypto mining. That is largely my contribution for this show. Done and dusted. Captain Crypto, hand you the baton.
Look, this is going to have a slightly negative tone to it. We don't want to... we want to try and find some positivity in the crypto space. There's going to be a negative tone to this. I think it's just shadowing what's going on in the wider marketplace. And again, just to give some substance behind this, tech stocks, we won't say too much about it, but big tech stocks, the S&P 500, the NASDAQ, they are all getting a hammering as well. Basically, high risk assets are being swapped by people for either liquidity or more security or more longer term assets. And you know, that's what happens when there's financial turmoil on the horizon. And we've got an energy crisis. We've got governments issuing bonds all over the place to fund wars. When governments issue bonds, they become a more attractive investment for institutional investors. So where you might have institutional money floating around crypto markets that might be classed as high risk in their portfolio, when governments are issuing bonds to pay for wars, you know, when the UK makes announcements and the US that we're giving Ukraine 100 million, you know, to pay for missiles, that's not Boris Johnson just taking the money out of his pocket and sending it to Ukraine. They're issuing bonds in the background to institutional investors to underwrite that money and then sending the money to Ukraine. So that's the sort of mechanics of what's going on. When that type of activity starts to happen, those bonds become attractive to people. So people take money from large proportions of sort of what's classed as risky investments, and then they allocate them to more secure, stable investments. Why would you not when the government's prepared to issue a 5-year bond, paying you a fixed rate for a longer period of time? So that stuff's going on in the background. That's triggering a really negative sentiment in the crypto and tech space because they are classed as the riskier investments, and then that just sort of multiplies itself, and it's just what's going on in the wider world. But that does have an effect on, I guess, we've just spoken about the macro sort of economic situation, but in the micro space of crypto, there's various parts of that are getting a hammering or going to get a hammering and having a terrible time, and part of which is starting to emerge. Because of the lower crypto prices, crypto mining is taking a hammering.
But the whole sector is, isn't it?
Yeah.
You can't have a drop of, 80% in value and it not have an effect on the whole thing realistically, especially when it's still a couple of million people strong. It's very, very niche, isn't it?
Well,
And
it depends.
it's a small sector.
We'll come on to that in a minute. So it depends on your outlook, and it depends how people have structured their businesses. Because don't forget, we're in the process of doing the mechanics behind setting up a crypto farm. Let's call it a farm, because there's going to be various parts to that, not just the mining. And so you have to, I have to be paying attention to what's going on and say, okay, is it still viable to do that?
Yeah.
And we'll go into a little bit of that in a minute. But just to set the tone, we'll talk about the big one, Bitcoin. Bitcoin mining, basically, without going too technical, the way it works is there's a difficulty level in mining. If that difficulty level is high, it takes computers more work. They have to do more work in order to receive block rewards, which is then being paid in Bitcoin for their services as mining. Okay?
Yeah.
So the difficulty level changes in Bitcoin based on the amount of computing power, what they call it the hash rate, but effectively it's the amount of computing power that's on the network at that moment in time. And it changes in the Bitcoin world every 2 weeks or so, there or thereabouts.
So if there's 100 computers, obviously there's not. If there's 100 computers doing the computation, they'll make it easier for those 100 computers to compete to work out the calculation. If there's 1,000, it'll become 10 times harder because they want to increase the level of competition for the same workload effectively.
It needs to be fair. So it needs to it needs to be fair. If it was really easy for everybody to mine Bitcoin, people would be effectively, if you're going to go and open up an industrial size mine, whilst you're going to be making most of the rewards, you can't also then go and kill off the smaller person by just simply taking up all the market share. So if that much computing power gets added to the network, obviously the difficulty level is going to go right up, because it's now needs to be made harder so that somebody can't just come in and take all of the block rewards.
Yeah.
If that makes sense.
So it's almost a algorithmic way of creating supply and demand.
Yeah, managing the workforce,
Yeah.
which are these worker nodes that are out there on this wider blockchain ledger decentralized network, without going too technical into it. But
I'm glad that was the top line version.
where we're getting to in May this year, 2020. In April, we're going to May. In April 2020, the difficulty level reached an all-time high.
This year.
So
2022.
2022. April 2022.
Yeah.
We are 2022?
Yeah.
Sure.
Yeah.
Positive? Sure. Been a long day. April 2022, Bitcoin difficulty reached an all-time high.
Right.
Which says that there were a record number of
Nodes.
nodes on the network. Lots of people
volunteering
mining Bitcoin.
their computer power.
Lots of people making Bitcoin.
Makes sense.
In May 2022, that fell to 4.33, or fell by 4.33%, which was the biggest drop in a long time in percentage terms. So that means that computing power is coming off of the network. Now, if you shadow that to the macro economy that's going on in the wider place, in March, at the end of March, by the way, a war started and everybody said it's going to be over in a couple of days, or in 5 days it's going to be over, or this is going to stop, or, that's...
Won't be allowed to start. We put sanctions on Russia.
And that was what, the end of March-ish, there or thereabouts?
Yeah, it must be. Yeah, it was still winter, wasn't it? Yeah.
Okay. In May, that war's now setting in. The energy crisis is happening. There was energy increasing all over the world. There was sanctions being started to put onto Moscow. So you can see how, over time, that sort of wider crisis is starting to unfold. People are taking their computing power off of the Bitcoin network. Now, that says to me that either resources are being allocated elsewhere, or it's becoming too expensive to mine, because this is part of the issue. If people are buying mining equipment at today's prices based on, and if the mining equipment providers are basing their prices on people making returns on where Bitcoin was in terms of pricing.
Yeah, of course.
Those businesses are geared up to make rewards or to make money based on a set of numbers, which has now changed significantly. So it fell in May 2022, and this week it fell again. So the second biggest drop of the year was this week, which it fell by another 2.35%. So we're now down 7% down in difficulty rate, which means that's power coming off of the network. That's hash rate going down. That's networking power coming off. Within reason, that's network power going down.
So is the difficulty rate? So you can say like the difficulty rate's gone down by 7%. Is that kind of like say almost not exactly, but that could be linked to
activity on the market,
computational power. So effectively, 7% of nodes are now working on something else.
Yeah. So it's a various of factors. It's activity in the market,
right?
So the network not being used as much.
Okay.
So a lack of transactions or transactions going down, and or computer power on the network going down as well.
Right. Okay.
So all of that combined, when that's put into the washing machine, the net result is that the difficulty rate of Bitcoin mining has come down. So there's two things in that. It could be a good time to get into Bitcoin mining if you can get the computer at the right rate. And actually, Bitcoin mining is really hard to become profitable because it's been industrialized at such a large scale, specifically in Bitcoin, and there's specific machines set up for Bitcoin and blah, blah, blah. But it's just a shadow of the sentiment. But what's concerning in all of this, and we'll come on to Ethereum in a minute as well, is that there are businesses out there that are geared up around, like I say, a sustained level of prices being at a certain point. And if your asset that you're getting paid in is now worth a lot less, well then, that has a negative. Could you imagine we're paid, our businesses independently away from this podcast are paid in British pounds.
Yeah.
If British pound became worth 80% less all of a sudden, our business models would be in grave danger. We're lucky
very quickly as well.
We're lucky enough to live in an economy that's pretty stable and doesn't fluctuate too much in terms of the value of the pound. But it happened when Brexit. So when Brexit happened, I actually had an active business that was doing big purchases in euros. So we was purchasing a lot of equipment and materials from the European Union at the time, and Brexit happened, and the price of the pound against the euro fell hugely. But the net result of that was materials became super expensive. So a contract that was £200,000, now when you've done the currency conversion, the FX conversion was now 350,000 euros.
Yeah.
And you've got a fixed price contract at 200,000 euros. You had a big gap. You had a huge currency fluctuation.
Yeah.
So as a result of that, currency fluctuation clauses started to appear in construction contracts to prevent that from happening again. So there was change in an industry. So I wonder what change is going to happen, because a lot of these big industrial Bitcoin miners are public companies that have huge they're publicly listed.
Yeah.
All of their shares are down because obviously the value of the asset that they create has temporarily fallen through the floor.
Yeah.
So I wonder what knock-on effect that's going to put into the marketplace however that washes itself out. So that's what's going on with Bitcoin mining at the moment. So it's one to keep an eye on, especially around the Bitcoin tech stocks. Because one way of looking at it is where they're public listed companies, and there's some big ones in there. And you look at it and you think, why is that a good opportunity to buy that now? Because obviously that's really cheap compared to where it was. So could you buy the stocks? Again, nothing we're saying is investment advice, but could you buy the stocks? And equally, if you believe in the long-term Bitcoin plan and the forecasts that people are putting out, it's now on a massive sale. Don't forget, this is an asset that touched $65,000 for one Bitcoin.
Yeah. In recent history as well. We're not talking about decades and decades ago, are we?
And it's now down at, I don't know where we are in the point of recording this podcast, but it's $16,000, $17,000.
Just gone over $20,000 again, I think, today.
Yeah. So it is on sale, and lots
depending on your viewpoint, isn't it? It's on sale. Yeah,
depending on your viewpoint.
Yeah.
And again, nothing we say is investment advice. Right, in Ethereum mining.
Especially Odders who gets all of his financial literacy advice from us, Odders. You've been warned multiple times now today on the show.
What's going on with Ethereum mining? Now, a different type of mining away from Bitcoin. Bitcoin use specific machines that are, nodes made to mine Bitcoin. Okay, they are specific. The other cryptocurrencies such as Ethereum, Ravencoin, and a few others, there's lots of others, they use a consensus mechanism called proof of work. So does Bitcoin. Bitcoin's proof of work, but they use proof of work and they use GPU mining machines, effectively a collection of graphics cards put together.
So super powerful processing
super powerful computer,
power, right?
Yeah, that could be used in graphics rendering, super computing power, like
3D drawings and architect plans and all that kind of stuff.
Yeah, that type of stuff, right? So it's super powerful computers, and most other cryptocurrencies use proof of work. so you can mine and go back and check out. We'll put a link in the show notes to the episode number, but check out the episode that we've done on mining, because you can crypto mining, because we sort of explain it in a bit more detail, and we're touching the surface with it here. But what's going on in that world is not only are prices low at an all-time low. I think ETH hit £800, maybe even gone down to like 780.
Yeah, so it was under $1,000, wasn't it?
Yeah. So not only are prices going down, so you've got the same effect where you've got businesses that were set up to mine at a certain level with a certain expectation and are now way below that. But you've also got Ethereum talking about moving to proof of stake, which effectively what that does in terms of the technical complexities, proof of work requires computing power to process the blockchain and make it work. Proof of stake uses validators, basically referees, to say, yes, that transaction happened. Yes, I validate that transaction. Go ahead and proceed. That's a dumbed down version of it, but it uses referees, validators. Yeah. Effectively, what you're doing is you're taking, instead of having lots of nodes, GPU mining machines doing the work, you're having one computer with a piece of software on it, which is just checking that the transactions happen, like a ledger, basically. So what that in theory does is it reduces the amount of computing power needed to make ETH work, and therefore, so people are saying, reduces the amount of carbon emissions that are required to run that blockchain, which is a big deal in certain places. Yeah. Depending on what you believe about how uneconomical blockchain is compared to other things. If you actually do the homework, and I've done a little bit of it, it's a very small percentage of carbon emissions comes from blockchain. If you compare that to AWS, Amazon's web server, what they use in power, it's a different, completely different.
Well, the internet is 20% overall of global emissions, isn't it?
Yeah,
the internet in general,
like
Bitcoin.
Blockchain's 1% of that.
Yeah, 1% of the 20%. Yeah, so it's tiny.
But the world's going to end because blockchain is out there working. But anyway,
It's Paul's personal opinion. None of what he said is the opinion of understanding crypto.
So Ethereum are under pressure to switch to proof of stake, obviously, because there are other blockchains that are popping up, like Polygon, like other blockchains that have popped up, which are actually side chains of Ethereum, but they're becoming more and more popular because they can say, well, actually, to mint an NFT on Polygon uses like as much electricity as it does to make
boil
a cup of coffee.
Yeah,
or something along those lines. So it's a better from a public perception standpoint.
Yeah.
But Ethereum have been threatening to move to proof of stake, or attempting to do it, for the past 5 years.
Yeah, I see. Yeah,
and they keep delaying the milestone back and back and back. But the latest milestone is supposed to be in August, and they haven't delayed it yet. So in August, Ethereum is apparently moving to proof of stake. Now, many analysts are saying it's never going to happen. We don't believe it. It's not going to work. But if it does work and they do move across, you've now got lots of people that had GPU mining machines, businesses set up based on mining Ethereum, that have all of these computers and nothing to do with them.
Yeah.
So what happens then? Well, you're going to get a dip, a massive dip, in our case, who want to build a mine or build a farm. You're going to get a huge dip in the demand for those types of machines. So therefore, the raw material price of those machines is going to come down, because graphics cards are at a huge high, because it's being driven by mining predominantly, in blockchain and gaming. Now, the cost of those assets could come down significantly if proof of stake button is pressed in August. Now, the good thing for us is we won't have our equipment by August, and therefore, with the way our project's panning out, we don't have to place an order until after that decision's made. And in August, they'll be saying, well, this is going to be delayed another 12 months, or it's going to go ahead, or it's not going to go ahead. And then you know where you are. So we're in a very fortunate position to make those steps. And the reason I said it's a farm is because what we could do is we could become a referee, a validator on Ethereum.
Yeah.
We could, instead of buying machines, we can buy ETH, we can lodge ETH, we can stake ETH on their network, buy a validating node, which is effectively just a server, install the Ethereum validated piece of software, and we can become a validator instead of a miner, and we can quite easily make that switch, because we'd be nimble enough to be able to do it. And where there are some larger miners that aren't, but those mining assets that people have got can be switched out to, they can become render farms. They can there's lots of other parts of the blockchain world. You've got a rise in file sharing, so blockchain file storage, which is a big one, which is coming up. So a lot of that equipment can be reused in a slightly different purpose.
Because
But
the
it's-
equipment at the moment is very expensive. Well, it's all relative, isn't it? It's, you know, you look at it sort of like, depending on what you buy, you look at it sort of like £20,000 ish, aren't you? That kind of price for a mining machine. But I guess the price is very, very closely linked to the value of the work that machine can do. So if, like say, overall this year, I think everything across the board is down sort of 60-ish%, isn't it? So you've got to think, whilst there's going to be raw material costs, what you're talking about is some very, very powerful GPU chips, a bit of casing and a bit of glass. Is it that it hasn't cost 20 grand to make it? It might be valued at 20 grand if it can return you at 69,000
but
per
the biggest cost
Bitcoin.
is these graphics cards. You know?
Yeah.
Graphics cards are coming in at $1,000 a card.
Yeah.
Just because the supply, but if the supply's dropped off, or if the demand's dropped off for the
Yeah.
supply, they'll come down as well.
Yeah.
So it's an interesting time. I wonder if, and again, nothing we say here is financial advice, but if you're the council of Ethereum and you're the DAO and you're voting in Ethereum and you're trying to pull the strings and make decisions, given the fact of where prices are at the moment, given the fact that there's turmoil in the market, given the fact that switching to proof of stake will create more turmoil and was an issue to certain people anyway, is that just going to get kicked down the road
You've got to sit tight for 2 years, haven't you?
even further and let things recover again? So let's see. Let's see what happens with that. But
That seems to be their model, doesn't it? They'll do an announcement and then it just keeps getting bumped and bumped and bumped, and then they do another. They're never really sort of like, I guess this is the sort of the beauty of the decentralized world. There's no one really to hold account for it, so there's nothing that's ever. Because I think the first announcement was like in 2016, and then it's just sort of like, oh no, we're gonna do it now. Oh no, we're gonna do it now.
technically, from a computer science perspective, proof of stake is very hard to make it work. It's even harder to make it work when you're already set up in a different consensus
way.
mechanism in a different way.
Well, they're gonna have two different types, aren't they? They're gonna have Ethereum Classic, and then the new Ethereum will work on proof of stake. They're not going to try and convert the old, are they? They're going to keep
correct.
that running in its
Correct.
current guise.
Correct, but look, it's interesting times. Let's see what happens. But it's definitely an interesting time to keep an eye on what's going on, and really, like, the point of this podcast is to sort of try and highlight when the market moves. There's lots of micro parts of the crypto space that's all having a little bit of an input into what's going on in this broader crypto market.
Yeah.
Which is interesting when you see it unravel and unplay what affects what and what's interlinked by what. You know, we haven't even touched on another episode how people are financially linked in this DeFi world. So, for instance, in the financial crash, what we saw was when Lehman Brothers went down and Bear Stearns and those banks, you know, you find out then that what was the government owned Bank of Scotland, Royal Bank
That's
of
right,
Scotland.
RBS, yeah.
The RBS had lent a hell of a considerable amount of money to Lehman Brothers and was massively involved in what Lehman Brothers. So Lehman Brothers crashed, it pulled down the Royal Bank of Scotland, which needed to be bailed out almost overnight.
Yeah.
So what's going to happen in how much exposure the counterparties have in this DeFi space? Because you read about it all the time. You see like A16Z or A16Z, as they say in America, have invested in this, and Coinbase Capital have invested in this, and
That's
this
right,
person has invested in this. So the whole DeFi world are invested in each other all over the place. But how many, where, when, what will be interesting to see is how this counterparty risk plays out of people being exposed to something somewhere that is a big enough exposure to bring that particular entity to its knees.
Well, who was it? It was, I heard this on another podcast. It was really interesting. So it was Voyager. I think it's Voyager, who are another exchange. They've had to go to a traditional bank and ask I think it was Citibank for a bailout.
For bailout, yeah.
Because they're well overexposed. And again, all of these sort of the algorithms have turned against them, and what they've been leveraging out and lending out on the sort of open Web3 market is just should never have been done. It should never have been allowed in the current guise. I will have to do a bit more digging. Maybe we'll come back to that story in a future episode. But it was another one where they pretty much, you know, it's like, oh no, this is the way it's going to work. It's decentralized, but actually then they put it out there, and someone else was going to buy the debt, and everyone was like, well, hang on, this is not what decentralized finance was supposed to be. But equally, if there's billions of people's money in this, and somebody else can buy the debt effectively, like a debt collecting agency would in the real world, then why would that not happen? But it goes completely against the whole methodology and the whole purpose of what this was supposed to be in the first place. We've talked about this on many episodes, haven't we? You know, what's the better devil that you know? You know, everyone says they want decentralized finance, they want to have complete autonomy, but do you? Because if you did invest into Voyager, and now all of a sudden they've over leveraged themselves, and actually, again, it's not decentralized. It's what we talk about, and you've sort of made this point on quite a few episodes. It's not decentralized. It's owned by a brand.
Yeah.
It might sit on the blockchain, but it's still owned by somebody.
Yeah.
So it's not decentralized at all. Yeah, it's a very interesting time, isn't it?
But look, the crypto world at the moment, Web3 at the moment is fast moving. So keep your eyes peeled.
Opportunities all over the place. Well, like I say,
personally,
depends,
and again, nothing I say here is financial advice, but personally, the bigger asset classes like the Ethereum, the Bitcoins, Solana, the ones that are so far along to, you know, that are, you know,
they're not newbie projects.
No. They've had, like, Solana's just had its record 2 NFT launches on it, like just a few weeks ago. And, you know, Ethereum the whole of the DeFi world is built on Ethereum.
Yeah.
You know, so yes, it's taken a tumble because of the broader crypto prices. And, you know, half of the DeFi world is in some sort of temporary trouble at the moment because of what's going on. But that's not going to go away. Like, they're not going to go away, and they are on massive sales at the moment. If you believe in the longer term vision of them and what they're going to work out, you know, it's, you know, what you know, take Ethereum. What was $2,500 for one ETH 5 weeks ago is now below $1,000.
Yeah.
Like, and that could quite easily go back to $2,500 in
Just as quick.
just as quick.
Yeah.
So
Depends
yeah.
on your risk appetite. Again, the general advice is still people like Gary Vee saying, just with all this stuff, do not invest money you cannot afford to lose. It's still that much of the Wild West out there.
Yeah. No, it
100%.
It is. But if you had a dollar cost averaging strategy on Ethereum and you're just buying it regardless, well, your portfolio is doing, you know, is gaining lots of momentum at the moment.
Yeah.
It's the way I see it, crypto, like, even us, we've started talking about crypto in the last year. We missed part of the boat. Like, could you imagine if we was doing this podcast in 2014?
Yeah.
You know, we'd be in a completely different place. And
We'd be living next door to Raoul Powell on the Cayman Islands, wouldn't we?
Potentially, yeah.
Being his mastermind.
Hello, Raoul, if you're listening. It's now is, it feels like now, because of what's happening, is a leveler a little bit. It now allows the people that believe in it, that want to get back involved. I heard a good analogy, and it made me laugh on a I think you sent me a link to the podcast, but they was describing it as a ship's left the dock years ago, and the crypto world is trying to pull the ship back.
Yeah.
And say, come on, we want to jump on.
Yeah.
Pull the ship back. We want to get on.
That's
And
it.
they're
Yeah.
pulling it back, fighting to pull it back with a rope, so that everybody could jump on it and it can go off again.
Yeah.
And it does feel a little bit like that. It's a great analogy that I thought.
Yeah.
It does feel a little bit like now could be the time to get involved at a much more level playing field than it was, say, 6 weeks ago.
I think also that what's come out from this episode, though, in particular, is that there are opportunities if you choose to perceive them in that way. And also you've got to be, if you are going to take those opportunities, you might have to be a bit more proactive. Like, you can't just do, to make the maximum gain, you can't just be doing, you know, well, a dollar cost average. You can do that as a good starting point. But actually, like I say, the differences are all of those GPU machines, they're going to go on sale as well. So do you get involved in that world? Do you switch your node to a validator? Like, there's all this stuff, but you have got to be proactively
on the ball.
on it. Because it's changing like weekly, isn't it? You know, I listened, we put out the previous episode 26 was almost like a bit of a sort of back to basics, not a highlights reel, but it was some essential clips from episode 1, 2 and 3. And my God, it was like, it might as well have been years ago. It wasn't dated because the information still stands to reason, but you're like, wow, think about what's happened in that amount of time. And it's a matter of months.
The crypto world does move so fast.
Yeah.
The same with, like, just simple tools. I said this before as well. Just a simple tool that you want that wasn't there yesterday pops up today.
Yeah.
Like, wow. Like, that didn't exist yesterday.
Yeah.
And it solves a problem.
Again, this comes down to your perception, either super exciting or super scary. Depends, you know, for people who want to invest for stability, this ain't the game to be playing. But for those who want to have potentially big returns for sure, big risks, it's a very exciting time.
The reason it moves so quickly, and again, I think we said it in the last episode, but just to cap off on this, it doesn't require the hardware. This blockchain does not require hardware to catch up. Previous tech cycles have required development in hardware to move the marketplace forward. So when we went from Web 1, I guess, to Web 1.5 or Web 2, where we basically development of mobile apps, that only happened because technology caught up, because now a mobile device was able to do what it needed to be done. Then there was also then a massive jump in the processing power in mobile devices. So mobile devices could do more as opposed to just fill out a form online or browse
3G,
a website.
so you can actually browse on the move.
So technology, hardware has limited the progression of tech over the past 10 years. It could have moved quicker, but it didn't require just software, which was somebody writing code. It required somebody actually development of product, development of new minerals to come up with new ways to build technology to move it quicker. Whereas blockchain will move so much faster, so much more exponentially, because it just simply requires people to write code. Like, that's it, people to write code. And as quick as you can get somebody to write code, you can develop a solution or a platform or build something, and you don't need hardware to make it happen. So that you're going to see this place shift and change and grow so quickly, which is why everybody's so excited about the growth, like analysts, of what could happen, how it could change, because it's not limited by Apple needing to develop a new product or a new graphics card needing to be developed by a graphics card manufacturer. It's just simple code and humans writing that code, which can shift it hugely and develop a new tool overnight.
Exciting times as always. Well, we've said it a couple of times. None of this should be considered financial advice, but we do hope that you've considered it to be informative, entertaining, or a bit of a mixture of both. If you have enjoyed the show, please feel free to leave us a review wherever you download your podcast. We will give some shout outs in future episodes to the best reviews. And don't forget, you can tag us on, why not? Might
Best
as well.
review reward.
We could, couldn't we? We could give them a coin. We could give them one of our coins, couldn't we?
We could. More than one.
Oh yeah, we could give them a few.
One is like
It's on sale at the moment.
10p, 50p, 5p,
5p.
5p.
We're going to give you a reward anyway. Not that you. Sometimes you should give without the intention to receive, but if you're that way inclined, then you're going to receive as well. Best ones are going to get a reward. Why not? Let's do something cool with it. We could airdrop some listeners some stuff, couldn't we? Yeah, let's do all that kind of cool stuff. Anyway, join us again for another episode. We'll see you next time. Ta-da.
This show is a Phonic Media production